Well, good morning, everyone, and welcome from London. We're going to have another FS Club webinar this morning, but it's a fun one. Now, that may sound a bit strange to you. An update on EU financial services legislation and associated initiatives. Where is fun in that? But what actually makes this fun is David Doyle. Dr. David Doyle is an old friend of the FS Club, or sorry, my apologies, a long-standing friend of the FS Club. And David typically opens every year, and we're delighted to have him back. And once in a while, we're lucky enough to get him at the halfway mark. And this is certainly an interesting period to be here, what with Brexit some 21 days old. Anyway, or a formal Brexit. So you'll know me, I'm Michael Mainelli. I'm one of the directors of Zien. And it really is my delight to be able to introduce many of these webinars. And the reason I'm delighted to do so is our sponsors are so kind and generous in allowing us to range widely and freely across technology, economics, and finance. And today's session certainly brings all of that together. David's got some remarks to make about fintech and digital services, and carbon trading, and climate change. He really is an expert on the whole variety of subjects, deep into what's going on within the EU, and frankly, with roles here in the United Kingdom as well, although he is dialing in from Paris today. Now, the format, as ever, is my job is to get out of your way so you can hear from our expert, David. David will be speaking for about 25 minutes, and we got a bit of a wake-up poll, so hands on buzzers, please. And we'll turn to Q&A certainly by 9:30. And David has always been very forthright and helpful in the questions and answers, but please do get them in early. I can already see a couple up here at the moment because I'd like to be able to throw them into the conversation so we have time to answer them. So with no further ado, David, I'd like to hand the floor to you, if I may. And we look very much forward to your remarks, as we always do.
Thank you, Michael, and greetings to you all. A very happy New Year. It's still time to extend our best wishes to you from the club and myself for the new year. So, what a new year! Well, probably the most important activity besides the new Biden administration and its different approach to European trade and economic negotiations with the EU is the beginning of the Portuguese EU presidency, which began on the 1st of January. And it began amid a COVID-19 inflicted health and socioeconomic crisis, with the full priority being given to implementing the European vaccination strategy and operationalizing all of the financial instruments agreed upon during the German presidency to ensure that money in this recovery fund, 750 billion euros worth, actually reaches the real economy as soon as possible. Now, the EU economy wasn't the only space that was badly affected, and indeed the health of citizens. Certain sectors and actors within the EU capital markets suffered too. One encouraging feature I think we would all agree on in terms of this COVID-19 crisis was the response provided, the very hastily but very well structured response that the EC, backed by the European Parliament and Council, actually responded to in terms of supporting the capital markets, and notably explicit attempts to limit the impact of the damage to banks by reducing some of the Basel III liquidity and capital requirements to ensure that banks across the 27 EU member states continue to provide liquidity to the real economy, notably to citizens and the SME sector. So a series of quick fix reactions have also been introduced, we'll talk about them a bit later, to support the capital market participants via the so-called quick fix and MiFID measures, many of which, somewhat ironically, go to the heart of deregulation at a time when the finger has been pointed at the United Kingdom by certain sources in Brussels about divergence by the UK vis-a-vis the European legislative agenda. actually the Europeans have also embarked upon some pretty significant and far-reaching deregulation moves, which we'll talk about a bit later. But the other, of course, big elephant in the room, and it would be amiss of me not to mention it, given the huge implications it's going to have for us both in the short and in the long term, of course, is the Brexit issue. Now, we all know that a trade and cooperation agreement was reached in extremis on the 24th of December between the United Kingdom and the EU. Now, the startling absence of financial services provisions was not entirely unexpected. I've been at pains to explain to people in the UK and elsewhere that traditionally EU free trade agreements do not contain financial services provisions. For instance, there's never any provisions in existing FTAs with third countries in relation to equivalency or passporting issues. So this has got to be treated as a separate issue, which is going to be mapped out in some detail in an MOU, which is to be reached or drafted and agreed upon apparently by March of this year, which was one of the only, in fact, reference to financial services in the trade and cooperation agreement. Now, this will obviously will not, and I think we need to be clear about this, will not contain any equivalency decisions per se, the MOU, but it will map out the priorities on both sides. It will map out a time frame. It will map out further memorandum of understandings about exchanges of information, about data, etc., etc. So that's already a positive issue in its own right. Sadly, there were a number of absences in terms of a temporary equivalency agreement pending further in-depth comprehensive discussions between both parties, covering issues on the 38-strong EU financial services regulatory agenda. We only had indeed one temporary equivalence decision in relation to the central clearing issue, which allows European counterparties to continue accessing UK-based clearinghouses until mid-2022. This was seen as being the single most important issue in discussions that were held between the EU and HM Treasury going back at least 2 years. That, if this issue was not satisfactorily dealt with a temporary equivalency agreement, it could ultimately lead to financial instability, and nobody wanted that, neither the Europeans or the UK. However, we didn't get any agreement of a similar nature in relation to the share trading obligation, nor indeed in relation to the derivatives trading obligation. Now, let me just touch on these two issues very, very quickly. The share trading obligation provides for access to European trading platforms, whether they be regulated markets or multilateral markets, on behalf of all member states and certain third countries, provided there is an equivalency agreement, which is not the case in the case of the United Kingdom. However, Article 24 of MEP-EU provides for share trading by third country actors in the 27 EU member states if the trades are non-systematic, not irregular, infrequent, and don't contribute to price discovery. So that they are some of the exemptions that are provided. As far as the derivatives trading obligation is concerned, and again, don't forget something like 80%, maybe a little bit more, of trading, clearing up trading, particularly in the FX and the interest rate swaps, takes place in the City of London. So there's a huge issue in terms of clearing, which has already been dealt with, at least temporarily. But for the trading side of things, which is a huge issue for both sides, actually third country actors, if they have third country branches in one of the EU member states, they can actually they are actually allowed to indulge in derivatives trading. One of those gaps that was overlooked in the initial derivatives trading obligation regulation. And it now, not surprisingly, many member states, notably the French, want to fill this particular gap. They don't see why this should be allowed under the sort of post-Brexit situation. Now, let me just pause for a moment. I'd like to get you all working a bit. We now have a poll we'd like to offer you. I'd like your views on the prospects of an EU equivalence decision. Again, this is a decision which allows, which is authorized by the European Union, which allows third countries to gain unfettered access for certain aspects and parts of the EU regulatory agenda, notably MiFID, MiFIR, UCITS, certain aspects of Solvency II. But what I'd like to ask you is, what do you think are the prospects of an equivalence decision for financial services in the next 6 months, over the next year, not at all, or don't know?
Oh, that's great, David. Over half the audience have voted, so just give me a few more seconds to let some come in. Folks, if you just click on the GoToWebinar Q&A slide, we'll get your results there. We're up to 80% of the audience, and I will now just close that poll and display the results.
So, predictably 9% in the next 6 months. I think I would probably endorse that particular notion. I just don't think there's going to be the time to do so. And in any event, we need to find out what's going to appear in this EU-UK Memorandum of Understanding, which will map out a time frame, no doubt, for the equivalency determinations for the next maybe 18 months. Over the next year, 43%, yeah, I would be cautiously optimistic. And in broad terms, I would agree with this. Cautious optimism that we could have at least some priority areas of the EU regulatory agenda subject to an equivalency decision over the next year. That is not by any means improbable in my view. Not at all. Well, I'm not entirely sure that I would agree with this. I think, let's be clear about this. This is not just a unilateral issue. It's a bilateral issue. It's a two-way flow where the EU relies quite heavily on the City of London. Let me give you the figures. 84% of derivatives trading take place in the City of London, according to recent figures. 82% of FX trades take place in London, and 42% of assets under management originate in the City of London. So given those figures, one can understand that there is I think an equal desire on both sides to get around the table, discuss the equivalence determination, and more importantly, perhaps, establish a firm, robust basis for EU-UK regulatory cooperation dialogue, something similar, by the way, which we have in place with the US going back at least a decade, and similarly for Japan. So just going back to this agenda, clearly the EU revised equivalency determination and assessment will not be like it was in the past. It's going to be a very different model, given that the UK, for all the reasons I've explained, is a very, very important player on behalf of the EU landscape. It'll be a forward-looking model. It will have to, by definition, take into account the interconnectedness that London has vis-a-vis the rest of Europe, in order to ensure, in the words of the EU, that customers are protected, and they also protect financial stability and integrity of the EU market. To be clear, the EU equivalence is not a passporting mechanism. I think we need to move on. This is not going to be passporting anymore. It's going to be an equivalence arrangement, which is not going to be that terribly comprehensive. Certain aspects of the existing equivalency framework does not include deposit taking, lending by banks, certain UCITS activities, and insurance mediation, which are not covered entirely. And the whole insurance Solvency II regime is not quite complete in terms of its third country access rules. As I've said already, in speaking to the European Commission, they are at pains to explain to me that there are two important foundations in terms of the relationships going forward. One, of course, is the equivalency determination, which is sadly still going to be a unilateral decision taken by the EU, but in terms of avoiding a nuclear situation where the European Commission could, with 1 month's notice, revoke an equivalent decision, this is where the EU-UK regulatory dialogue and cooperation committee will be able to review issues upstream before they become major problems and determine what can be acceptable on both sides in terms of divergence. Again, this already works within the context of the US and Japan, and there is an expectation on the part of the European Commission that this will be the foundations going forward. The other, I think, important issue is in relation to clearing houses. And again, the European Union has indeed introduced quite separately a third country CCP regime, where ESMA will be given the role, in cooperation with the European Central Bank, to review all third country clearing houses that have significant, in particular, euro-denominated derivatives clearing, trading and clearing in the 27 EU member states. And they can decide, or at least recommend to the Commission, if upon assessment of the third country CCP, they find that there are certain shortcomings, there are a number of weaknesses in terms of the assessment procedures, the risk procedures, the degree to which the hubs have substantive staff based in one of the 27 member states, they can recommend ultimately, and as a last resort to the Commission, that this third country CCP be forced to relocate its activities, particularly euro-denominated derivative clearing, to one of the 27 EU member states. Again, these are the sort of issues that can be picked up very, very quickly and early in the EU-UK regulatory dialogue and cooperation. Now, the other big elephant in the room, which I think many people have missed out on, given the overwhelming narrative on Brexit for particularly in the last year, is the new powers that are going to be vested with the European Central Bank. From the 26th of June of this year, under the new European Investment Firms Directive and Regulation, the ECB will be granted direct supervisory powers over all large systemic investment firms that operate in the European Union. And this includes both domestic investment firms, but also third country firms as well. This means that any investment firm that operates in Europe with assets under management of in excess of 30 billion euros will be required to apply for a banking license. Therefore, ipso facto, they will become and they will be treated as a bank, with capital requirements, liquidity requirements, and a lot more disclosure. And indeed, ESMA has produced on the 31st of January of this year, of last year, should I say, a draft consultation document on the deep, granular level of disclosures that will be required under this piece of legislation, down to even third country branch level. Huge amounts of information are going to be required. It hasn't been agreed upon yet, but clearly this whole landscape in relation to investment firms is going to change radically. Now, it's no surprise to you if I say that there is an enormous amount of pressure from third country investment firms to see an equivalency determination and decision taken on this important piece of legislation. Huge implications going forward. And also there will be, yes, sir.
Just quickly before we move off this, there's a question here from Hugh Purser about how up to date are those figures you gave for derivatives FX AUM at 84%, 82, and 42. Has it shifted at all since the referendum? I realize 3 weeks is a bit early, but just a kind of a quick
I think I'll have to say I don't know because no updates have been provided. No doubt on the share trading side, yes, but derivatives, it's not clear to me.
Okay.
So perhaps we can move to the next slide. I wanted to touch on what I see are the six top regulatory priorities going forward. Obviously, again, the other big moving part in the landscape is the COVID-19 measures under the Recovery and Resilience package. This is now worth a stunning 1.075 trillion euros, 750 billion of which will be devoted exclusively to addressing the outcome of the COVID-19 pandemic, which will go to sovereign states, to workers, to businesses, to prop them up. Now, a couple of important, I think, factors to mention here. Member states, particularly the southern member states, Italy, Spain, Greece, Portugal, who were most adversely affected by COVID, and all the other 27 member states will have to provide national recovery plans to be submitted by the first quarter of this year, on the basis of which funds from the 750 billion euro fund will be dispersed, allocated from, I believe, July, maybe August of this year. 37% of this fund will be exclusively devoted to the EU climate and green transition activities, and a further 20% to digital innovation. In other words, member states will have to factor in these two important features in terms of their national plans. The EU intends to raise quite a large amount of this funding through capital markets, and in fact only this week they announced that in terms of the total capital to be raised on the capital markets, 30% will come in the form of green bonds. This is I think the firmest measure and narrative we've seen from the EU in terms of their alignment with this whole green agenda. The other aspect, and it's still being discussed, is what are the sources of funding will be sought, because quite visibly nearly 1 trillion euros is probably not going to be enough over a 7-year period. Additional funding will have to be raised to bring the European landscape up to a point where it becomes less reliable on third country digital and financial services, according to a strategy paper which has just actually been released this week. And clearly what's been looked at is a tax on multinational companies' turnover of 0.2%, a digital tax, which is already moving and has picked up pace since the beginning of the year, a plastics tax, carbon border tax, and the highly controversial and much hated financial transaction tax is also being reviewed as well. The other big agenda is in the field of anti-money laundering. And here, a big game changer, in my view. After years of relying on anti-money laundering directives, some of which were either late in transposition, subject to divergent interpretation, and typically there was no cross-border dimension in terms of supervision, the Commission has decided to go for a game changer. It's talking energetically and assertively about the creation of an EU centralized anti-money laundering agency, which will be independent, which will have the powers to be able to oversee the compliance of the banking sector, at least initially, in terms of the anti-money laundering legislation. There's also talk about consolidating all of the 5 existing anti-money laundering directives into a omnibus regulation. So more about that, I think, at the end of this first quarter, when the Commission is due to issue its strategy paper in terms of the steps going forward. The other area is in regulation in relation to the whole sustainability and sustainability finance. ECG, climate change risk agenda. Upcoming on the 10th of March, we have the disclosures, regulation on disclosures in relation to the sustainable investments and sustainability risk, which must be applied at least at level 1, which will cover all manufacturers of financial products, and indeed even the distributors and financial advisors to end users, in terms of describing how their products actually match the sustainability agenda, notably and primarily in the field of environment rather than in terms of social and ethical concerns. Now, critical to all of this, central to all this, is the other big piece of legislation, that's so-called Taxonomy Regulation, which is going through further delays as we speak. This was supposed to define, according to 7 or 8 criteria, which economic activities in Europe actually do contribute to the sustainable environment of the 27 EU member states. And what's holding it up is gas. There are quite a large number of council members who object to gas infrastructures as an economic activity being excluded from the debate. What they want to see is those activities that actually do contribute to the economic sustainable environment, but also those activities which are brown activities that actually damage the environment. And clearly, there's a lot of carbon-related industries that still need to work through in terms of this taxonomy regulation, in terms of whether they will be included or not, or whether they will be considered as a transitional activity. It's a usually politically charged issue. It will delay the entire procedure and implementation, in my view, going forward. Completion of the Basel III reforms, particularly in the light of the COVID-19, where the Commission worked very energetically with the Commission, with the Council and Parliament to introduce some quick fixes to enable banks to actually use their buffers to continue to lending to the real economy. The other big issue, obviously outstanding, is the so-called output floor, whether the internal models used by banks for calculating the risk-weighted assets should be introduced or reinforced, or should we be going for a standardized approach to ensure that banks are actually measuring the risk-weighted assets going forward? It's a big issue that will only be dealt with towards the end of this year. Relaunching the Capital Markets Union, I think probably the most important issue here is the quick fixes that have now been introduced, are being discussed and ratified at final stages by the Council and European Parliament. Let me talk about that a bit later. And the whole launch of a brand new EU digital finance strategy, which will look at issues for the first time ever in terms of actors in this digital space, and particular emphasis on developing an indigenous European digital, as it were, environment with actors from Europe, licensing artificial intelligence, machine learning, retail payments, cryptocurrencies and assets, digital operational resilience, and an oversight mechanism for third-party providers, which will include third-country providers as well. Next slide, please. Deregulation, well, it's a great, as I said earlier in my presentation, I started by saying this, one of the great ironies of this whole divergence debate in the context of Brexit is that actually the European Union is embarking on quite a significant deregulation move of its own in the form of the so-called quick fixes to MiFID. Now, this has massive support within the Council, within industry, not surprisingly, and by the majority of MEPs. Basically, what the MiFID regime is focusing on in these quick fixes is reducing or exempting or eliminating unnecessary, burdensome administrative disclosures to both clients and to regulators, to allow big trading firms, brokers, banks, asset managers to concentrate on what they should be doing. They're going to be phasing out, for instance, paper-based communications to retail investors if they so wish, and certainly for professional investors, and shifting almost immediately to electronic investor communications, exemptions for costs and charges for eligible counterparties and professional investors, except for investment advice and portfolio management, a distance communication option for all investors will be suspended on ex post delivery of course charges, as it wasn't seen as being very useful. But you know, the most important game changer here, let me jump to the end of this particular slide, was the suspension of the best execution reports, which is being suspended until 2022, when the Commission will review the need for such reporting in great detail, which was not seen by the vast amount of industry as being particularly useful. And of course, there are also new definitions in terms of retail and professional investors going forward, which will help to encourage more retail investors to come into professional investor type financial instruments. Now, the big issues also facing the EU at the moment is in the field of the non-banking sector. And here there's been a lot of discussion about the role played by fund managers who already entered the COVID-19 crisis, according to the IMF, the FSB, and ESMA, with huge liquidity mismatches in many of their funds. The OECD estimated that something like 40% of all corporate bonds were deemed to be illiquid. And not surprisingly, at a presentation that I shared yesterday at the European Parliament with an ESMA senior official, he did touch on two very important issues to summarize this particular slide in terms of deficiencies going forward that need to be addressed. One was the liquidity risk and management, some funds presenting potential liquidity risks and deficiencies in liquidity risk management, or valuation processes. Only a very few funds, they said, have adjusted the liquidity process in the light of the COVID-19 stress. And asset valuation, concern over the valuation of portfolio assets has clearly emerged, particularly in the real estate funds area. In fact, ESMA estimated some 18 months ago that already AIFs in the retail estate fund space had the highest proportion of illiquidity of all the funds. A significant impact in the longer term is possible. Infrequent adaptation and adoption of the liquidity management tools, and indeed one of the issues going forward is pretty obvious, that is to bring the whole liquidity stress testing mechanism to cover all categories of funds and not just AIFs. Next slide, please. And last but not least, there's also moves, no doubt, driven and triggered by the Brexit situation, to align AIFMD, UCITS, and the MiFID frameworks, which ESMA has been pleading with the Commission to do for some time, particularly in the field of AIF and UCITS reporting, covering both management and fund-specific data. The delegation issue, which is highly contentious. This particularly is contentious for the UK fund managers, who obviously use the delegation model quite frequently and quite assertively in terms of servicing the 27 EU member states. The question will be, will this be banned? I don't think so. That would be my personal view, but I think we can expect much more intrusive, granular information to be provided by third country investment firms as to why how they can justify the continuity of the delegation model, particularly as it relates to risk portfolio and even certain legal issues as well. Supervisory non-alignment of seconded staff. This already came up on the Brexit issue, but this is already being raised. You know, to what extent do seconded staff become quasi non-permanent part of part of the 27 EU member states' activities, while they are actually based and hosted in a third country headquarters. This is particularly relevant for management company level, third country arrangements. Support tasks fall into the same category. To what extent should there be some degree of criteria set for third party professional firms who provide certain services on a ad hoc basis, but who are based in third country countries? And the liquidity testing rules, which I've already mentioned, should become rules binding. Next slide, and then I think we can perhaps pause. And back to you, Michael. I think there may be some questions.
Thank you very much. Yes, you're always full of content, so I'll let you overrun a little bit, but we've eaten quite a bit into Q&A, so we'll need to be quite snappy on some of these answers. So I'll start off with a quick one. Bob McNally is curious, how much influence will the ECB have in shaping an equivalence agreement?
The ECB, none whatsoever, at least on paper. This is an European Commission mandate prerogative given to it by the treaties. What the Commission can do, of course, is it can delegate the equivalency determination, the on-site assessments to ESMA, the EBA, and EIOPA. But the ECB don't have a direct role in this equivalency determination.
Okay. Robert Pay is curious. Dr. Doyle, you mentioned gas, but given the very different views of nuclear between France and Germany, how will nuclear be treated given that it is carbon neutral?
Well, that's the very question that's being posed as we speak. Is it neutral? Is it an evolving transitional economic activity that over time could become less damaging to the economy? Right now, there's quite a large number of council members ganging up against the likes of Germany and Poland, two big producers of gas, and asking, should gas be not further, should it not be further subject to assessment, or perhaps completely removed from this debate and left to another stage and allow the taxonomy regulation move ahead? It's a very controversial issue. It's the same for coal, and it won't go away anytime soon.
Folks, and Robert, you might, we had a session late last year with Michael Schellenberger making a cogent argument as an environmentalist for nuclear. Very interesting debate. Freddie Geelan asks, David, very interesting insights, thank you. One question on the IPU, what are the practical implications for UK firms operating in the EU?
Well, like all third country banks in excess of the 40 billion euros of assets under management, with activities, of course, either at subsidiary and or branch level in the EU, will have to set up an IPU before December 2023. This includes third country entities as well, and they will apply the same rules. What's not clear at this stage, but will be clear by the time we get to December 2023, is how third country bank branches will be supervised and overseen in this IPU framework. For the moment, third country bank branches are included in the calculation towards this 40 billion euros, but they're not actually covered under the supervisory mechanism, which again it would fall to the ECB. The branches would still continue to be supervised by the home state country. But by December 2023, we will have an EBA study into how the 27 EU member state national competent authorities actually handle third country branches, to discover, no doubt, that it's a very divergent approach, there's no consistency, and the ECB would say this is unacceptable. These third country branches need to be brought under the SSM single supervisory mechanism in the same way as any other bank, whether it be domestic or third country. So there are the issues we do.
Rick Dedine is curious on the same issue, or related anyway. How will the UK adopt the EBA guidelines on outsourcing arrangements?
Well, my understanding is that the UK is probably slightly ahead of the EU on this one. And I think today, where we stand, you'll probably find there's a pretty good alignment between what the EBA is proposing, which again is only guidelines for the moment. It's not rules binding, and that of the UK. It's one of those areas where the UK, I think, would probably be a little bit ahead of the rest of our European partners.
Okay. Ian Sheridan is curious. The UK is a top 5 fintech economy. Yet it would be illogical to ignore the depth of MiFID and other EU regulation in the UK FS sector. Is equivalence a fetter on UK innovation? For example, we created the sandboxes here, not in the EU, although it's been emulated. And any thoughts on whether this will dampen or perhaps increase innovation?
Well, right now, where we stand, it will probably increase innovation. I mean, the UK is already a clear leader in this fintech space. There are a couple of examples in Estonia, Malta, Cyprus, but nothing on the same scale as that of the City of London. And the reason is that the City of London has moved both in terms of regulation and in terms of being a catalyst, providing the necessary measures more than other countries. Now, France is actually catching up quite assertively in this space. But what will Brexit have in terms of implications? I think we need to wait until we see the Commission's final regulatory approach to regulating fintech firms. They want fintech firms to be regulated over a certain magnitude of assets, a bit like banks, with capital and liquidity requirements, with disclosures and so on. And that's certainly the way the ECB is also thinking. So we need to wait until the Commission has finalized its regulatory approach to that to determine whether there are any divergence with that of the UK or whether there's any degree of alignment.
Okay. Folks, I will be sending all questions to David with your email so that he can get back to you if he wishes, and there are quite a few here, but I'd like to close on 2 if we could in the very short time available. Shan Turnbull refers to the Nobel Prize winning economist Elinor Ostrom and her studies on management of the commons. He points out that she states you can only regulate complexity with matching complexity, and this requires neither markets nor state. So he's curious about why is Brussels not proposed achieving deregulation by introducing private self-regulation, sharing data and powers stakeholders. I must say this has long been a Zien theme. It's what we call voluntary standards markets, but there are whole chunks of regulation that could be done through mechanisms like kite marks. And it's just curious, in the corridors of Brussels, is this being discussed, or is it all the usual 3 regulatory bodies dominating?
Well, the whole data management space is under a massive review. We've had at least 3 ESMA consultations relating to MiFID, MiFIR, EMIR, all of which have huge data issues. The issue is very simple. The issue on mainland Europe and in Brussels and in Frankfurt is one of how can we move towards a standardization and better quality data that services both industry, particularly the fund management industry, and the national competent authorities who should be reporting this to ESMA and the ECB. And the second related area is the consolidation and standardization of data disclosures between different pieces of legislation, notably between MiFID, MiFIR, and EMIR, between the trading and the clearing in the equity and non-equity space. So that is the immediate focus before we move on to how should this be delegated and who should have the responsibility? Until we solve those issues, the other issues will remain, I think, fairly academic for the moment.
Okay. And then really just to close, a number of comments here, and I'll wrap, I think I can wrap three together as one, really. Firstly, the EU has a longer-term aspiration to increase the role of the euro as a reserve currency.
Yep.
Is this fanciful, or will it indirectly influence any equivalence agreement? Secondly, are there any internal pressures within the EU to accelerate the equivalence agreement? And finally, is it really the case that political stakes will play a higher role in any equivalence agreement than almost any other commercial interests?
Yeah, there are two separate questions there. On the euro, over the last 48 hours, the Commission has issued a strategy paper entitled Europeans' Economic and Financial Sovereignty. Now, this speaks to primarily measures that need to be taken to boost the role of the euro as a trading and payments and reserve currency. As you all know, the big dominating currency is the US dollar. And this has come to the surface primarily because of short-term issues, because the euro has gained something like 9% against the US dollar in the last year alone, which is damaging the European Union's attempts to boost exports as, again, a contributing factor to restoring the economic stability of Europe. What's kind of worrying about this euro sort of focus, and I haven't had time to fully analyze the paper, is the words, the narrative that comes out in terms of reducing dependence on the US dollar and foreign financial hubs, quote unquote. Now, this is not unusual. During the COVID crisis, the European Union, I think you overwhelmingly felt that the European Union was over-reliant already in terms of health hubs or medicines that were actually produced in great proportion in third countries. I won't mention them. Now we're shifting the focus to potentially to foreign financial hubs that are providing much of the financial transactional space in Europe. There's not much detail in this paper. I think we need to see it a little bit more fleshed out. But clearly, there is a determination on the part of the EU, backed by some very large EU member states, many people within the European Parliament, to reduce, in general, the over-reliance of foreign companies and entities in three distinct areas. One is healthcare, one is health, medicines in particular, financial services, and the digital services as well. And that's about as much as we can say for the moment. We need to see the further details in fallout of the strategy paper. The second question, is there anybody else in Europe pushing for an equivalency, accelerated pace on equivalency with the UK? Well, it depends who you speak to. There are some hardcore countries in Europe that do not want to make this equivalency determination a walk through the park by any means. They think there's already too many gaps in existing legislation. I mentioned the derivatives trading obligation, for instance, as being one of them. But there is also, I think, a realization that nobody in Europe wants a detrimental breakdown and rupture in the financial flows between the EU and the United Kingdom. There's this interconnectedness and this footprint the UK has vis-a-vis the rest of Europe in the trading raising of bonds and share issuances, hugely originating in the UK on behalf of the rest of Europe, is a big issue, and it's not going to be replicated anytime soon in the rest of Europe. So hence, we're all, I think, keeping our fingers crossed that the next 6 to 8 months will be pretty determining in terms of a more mature relationship between both parties in terms of determining equivalence, in signing up to further MOUs on information exchanges, and setting up this robust EU-UK regulatory cooperation dialogue as exists already with the US.
Great. David, as ever, I've let things overrun a little bit because you've got so much content, but I'm afraid we do need to draw it to a close. And may I do so with 3 rounds of thanks. First round of thanks very clearly to our sponsors, virtually all of whom are extremely interested in what goes on this equivalence agreement, what the relationships are going to be between the UK and the EU, and in fact, frankly, the EU and the world, which affects all of us. So thank you very much for those insights. I'd like to thank you, the audience, as ever. Very vibrant discussion. Hope to come back and hope to bring David back perhaps mid-year and certainly early next year, if at all possible. We do have a number of things coming up. So again, very full. Have a look at the website. But I would point out at midday tomorrow, we have Iona Bain. If you want to hear everything about what young people really think about money management, she is, of course, the great doyen of that sector. And finally, David, of course, as ever, a delight to thank you. You're always welcome here, and we enjoy it. The technology, as you know, does not permit us to open the floodgates for applause, but I have brought a little applause meter, my Korean karmic clapper, and that will, I'm afraid, have to do with the claps. But thank you so much for coming.
Thank you. Thank you very much. Look forward to seeing you again.